Well, good afternoon. I think even though it's the 8th of the year, ninth of the year, I can still say Happy New Year one last time. Welcome, investors. Bull Sessions is back. My name is Mark Robertson. I am founder and managing partner of Manifest Investing. I'm joined here by my dear colleague, Mr. Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. Good afternoon, audience. It was a nice vacation. I began to miss doing bull sessions about 3 or 4 days ago, Mark, so this is just about the right timing, okay?
Well, as I mentioned in the green room, have received several notes also kind of welcoming, extending a welcome to us coming back. Kim is probably going to join us later. Matt Spielman of Houston, and many of you know his voice from a number of our programs here. Happy New Year, Matt. And I'm going to try to speak slowly and quietly because I believe Matt was out late last night with the Wolverines celebrating in the streets of Houston.
The ears and the mind are fine. The voice is only available with some effervescent assistance.
I was
So
I
you
was
were out.
looking today. I was looking today, Matt, to see if they were burning couches in the streets of Ann Arbor, but I didn't notice any articles about burning sofas, so that's good.
I am quite proud of my extended Wolverine family. Although I was with a alumni association package, the hotel had Huskies too. We were actually across the street from the Husky team hotel,
Okay.
and it was probably some of the most well-behaved, very enthusiastic for their side, no trash talking, no whatever, but well-behaved on both sides. So welcoming the Huskies to the Big Ten, and maybe we've started a new rivalry.
Excellent. Yeah, good stuff. In fact, our son Alex was in the Ann Arbor area last night, down around west of Plymouth, and he said that the celebrations were solid and well behaved. So kudos. No burning couches or cars being turned over. That's a good thing. All right, so we're here to celebrate an epiphany, and again, we cover a lot of animals at Manifest Investing. Ken, I don't know if I missed any on the slide, but just wanted to
I don't
point out
I,
that
I don't see a rhino here, Mark, so I don't
you know,
know.
a rhino. There you go. We're missing a rhino. Could have thrown a bison up there too. No, I just here just to remind everybody that the sheep and the camels and the donkey, they get a lot of airtime and they had an important role in the Christmas story, but they stayed at the bull's house, right? So he was the place that gave them the abode. So stuck
Now,
our bull in there.
Mark, we have had some of people in our audience question whether this bull is really a bull or not. So
That's true, but the Australians from down under have a certain advantage of perspective. So that's where those comments are coming from, by the way, Australia. But I did put our Dogecoin dog, and there's a groundhog up there in the upper left, and the Twitter birds are there. But hey, we're here to kick off a new year. We're going to take a look at a number of the portfolios at Manifest. Not going to spend a lot of time on them. We've got a lot of slides today. And then we're going to dial up a demonstration. And this is something that Ken and I have talked about doing with a modest amount of real money, but just literally walking through, kind of building on some of the getting started stuff that we did over the holidays, and just having some fun doing it. Anything you'd like to add, sir?
no, let's get started, Mark. We have this disclaimer to get out of the way and this picture of the Bucky's and the Portillo's signs.
It's a double feature today. Yeah, Michigan is rumored to be getting one of the next Bucky's locations. They missed out on the next 10, but they're not too far down the path. And of course, the rest of the slide is dedicated to Portillo's and our weekly reminder that Portillo's is not a sponsor of this session, but they should be. And Kim will have a story about actually running into an executive from Portillo's at a future session. Here's a slide that we used during the Getting Started series. Again, just for those of you that don't know us very well, just give you a little background on the two of us, including our significantly better other halves. And you can see that Wendy and I stopped by Bucky's on the way on our most recent road trip. So I'm not going to read the slide to you, but basically the nutshell version, Ken and I have both been doing this for quite a while, simply working with people within the community of the modern investment club movement, trying to help people do better. All right. I don't know if I got all the additions or anything in there you want to add, Ken?
Well, this is the former
Former
bio
slide.
slide, so that's okay. We'll get the updated bio slide eventually. So.
Okay. Yeah, this slide might go away for a while. All right,
Yep.
here's the real disclaimer slide. Everything we do here is about education, and specifically the demonstration and illustration of the philosophies, methods, techniques, analysis, approaches, portfolio design and management type stuff, basically promulgated by the National Association of Investors, also known as Better Investing and Manifest Investing, and our own interpretations of that stuff. You're basically talking about 8 decades of demonstrated good foundations for investing, and that's literally what we're talking about: finding good companies at good prices, great companies at great prices, and basically owning them as stewards as long as it makes sense to do so. But please do your own review or analysis of any company before you make your own decision. If we own something, we'll try to remember to talk about it, but make your own decisions about everything associated with the campaign or crusade that can be long-term investing. We do a monthly program called the Roundtable. You'll hear more about that as we go. If you'd like to be added to a reminder list for that monthly event, send an email to nkavula1@comcast.net. And if you'd like copies of these slides, or if you have suggestions for future topics, and as you'll see, nominations for a portfolio or things you want to discuss about a portfolio, a Bull Sessions portfolio, please send us an email at either of those 2 email addresses at the bottom.
Mark, Natalie's been getting a lot of emails asking whether people can share the links that she sends out to the roundtable, or
Yes.
whether they're just for one person. And the answer is you can absolutely share that link with as many people as you'd like. You can send it to your group. You can send it to your family. You can give it to your neighbor. That link is good for as many people as you want to share it with. If those people would like to be added to the list to get the link directly, they should send an email to Natalie as well, and she'll walk them through the process real quickly. We're no longer able to do it directly, but it's an extremely simple process that we can do with people in under a minute. So either way, we're glad to have you with us. You don't need any membership of any kind, just a computer and the ability to want to sit and listen to the roundtable once a month, or whenever you have the time to make it happen.
Okay, pressing forward, here's a look at our slide. I don't know if I'll show this every week this year, but it's kind of telling right now. We had a very strong finish to 2023 with the surge in November and December. The green bar actually reached up and touched that long-term blue trend line. Keep in mind that the green bars they represent the value line arithmetic average, which is quite literally the average of the 1,700 companies in the standard edition for the Value Line Investment Survey. And the bars that you see there are quarterly. So the one on the far right is a work in progress. It's only a week old, but we had a few tough days to start the year, and actually that bar has dropped back down below the line. And so we're basically just showing a couple different forecasts. We believe that the methods at Value Line and Manifest and Better Investing are kind of joined at the hip. So those forecasts are going to run together most of the time. And pretty good picture there. And you can see that as of the end of the year, we did reach a fairly normal 3 to 5 year appreciation potential. According to Value Line, you can see the math there, and my par actually lines up pretty closely. Anything else you'd like to add there, Ken?
Nope. That's things are nice and normal right now, and I don't mind that at all.
All right. I really like this one. This is our annual histogram. It's a concept borrowed from Ibbotson a little bit, so we'll give credit where credit is due. But these are actually based on the Value Line arithmetic average, whereas Ibbotson uses, I believe, the S&P or the Dow. I'm not sure which it is. But again, this is just reflecting where the results for any given year end up in this result. So Ken, I know it's your favorite slide. What do you see here?
I really like that slide. If you're looking at Ibbotson, it is S&P that they use in the 2023 block, which is at the top of the 1020 line, would actually be at the top of the 2030 line for the
Yep.
S&P. So the graphs have some slightly different shapes to them. But when it's all said and done, it basically shows that your chances of being positive are much greater than your chances of being negative in any given year. And when you reshuffle this data to look at 3-year periods or 5-year periods, those chances of being negative actually decrease significantly then.
Yeah, a lot of those just to the left of that line I just drew at 0% are actually low single digit negatives. So there's actually been only a few that are kind of off the charts negative. We lived through one of those out here during the financial crisis 15 years ago. And Ken, you already guessed the answer to this, but we'll offer it to the audience. Those green blocks are not the result of Mark running out of red ink. The green blocks, the darker blocks, actually have a method to the madness. Anybody in the audience care to take a guess at what they represent? Because whatever condition we're representing here, it happened for the first time in 2023. Any hints you want to give the audience, Ken?
Well, we're talking about good years and bad years. I think we can go that far.
Okay. Oh, and by the way, again, we do like to reinforce that 1958 was not only one of the best years in the stock market history, but the year I was born. So clearly there's a celebration going on there.
Must have been,
Any guesses in the box that
we're not getting any
it's a hard one.
anybody willing to step out of the comfort zone here yet. So
All right, so every one of those green ones is the year following a negative outcome. So for example, in 2022, we had kind of a rough year. Notice that 2023 is here, and it is the first time that the bar has actually ended up in the 10 to 20% range following a bad year. So following a bad year, of course, with 2008, you can find 2009 over here somewhere. Here it is. So every one of those bad years on the left is followed by a green box. Most of those green boxes are landing over here. Everybody see that? I think it's kind of fascinating. And then, of course, down below to really capture perspective, those are 10-year rolling average annualized returns. And notice that they do not actually, even during the worst of times, which is right in here, actually reach zero when you talk about a 10-year time frame investing in all of the above type investing. So that ought to jump off the page at you. That's why we invest in small, medium, and large. That's why we worry about, we don't even think of long term as more than 1 year. Anything from 1 year to 5 years in our perspective is actually still pretty short term. And,
remember when the phrase of the day was the lost decade? That seems proven.
It's there for sure.
Yep.
All right, moving on, because we do have a lot of slides. This one is pretty cool, guys. We've had a pretty good run with our Delex, and the groundhogs are shooting up the page. The numbers are gaining fairly rapidly. We are back to an 8% average groundhog return. The market's checking in at 14. The value line arithmetic average is down around 2. But we can see that Ann Renly is holding tight to her leadership position. Kim and I have both moved up fairly high into the standings, and Matt has moved back up thanks to largely, I believe, our Delex. Any portfolio that has our Delex is color coded in orange, and we'll probably switch that back because we don't want to jinx ourselves. Because Ken has convinced me that somebody's watching us. So some pretty good stuff there. Ken advises me that he's still happy to be in the top 20.
Just stay in the top 20. That's my goal. So,
And as we said in the green room, Sandy Castor jumped from 45 to 25. So Ken, you've got some competition coming.
all right.
All right. So the number one ranked club right now is Orange County Model Club. They were our group champions 3 years ago. And the two most recent years were the Space Coast group out of Florida. So, and they're just barely off the list. So I keep watching for them to start bubbling up because each of the past 2 years, they've come from behind to win it in January. All right. Anything else here? Kathy Wood went back to 57th. She got as high as 38th for a while. And the monkey is almost off the charts to the downside. So we can be happy about that. All right. So let's do a little parade in honor of the Rose Bowl, but we're going to do our portfolios being on parade. And by the way, the Rose Bowl parade, here's a bit of trivia for you. Hugh McManus lives not too far from a fairly large park that's at the end of the parade. And when we lived in Southern California, we wouldn't go to the actual parade itself. But what they do is they take all these floats and they park them at this park, which is literally a stone's throw from Hugh's house. And you can go right up to them. The day after, they park them all and they let you take a look at them, and they are spectacular. So good stuff. Pasadena Rose Bowl Parade. The parade's pretty good too, but we always enjoy just going to them at the park. So let's take a look at our portfolios. Here's our performance perspective, our moment from Trading Places. We think that that's true, by the way. It might have been a sarcastic moment in the movie or whatever, but we think it's true. Our Magnificent Seven, it's not the same as the market's Magnificent Seven, continue at the top of this chart. They are all among the Manifest 40 most widely followed companies. And we'll take a look at some of these portfolios along the way. And Ken, the mid caps and small caps do continue to make progress and towards repairing themselves a bit.
Absolutely. We might actually see the whole chart green pretty soon, huh, Mark?
Could be. All right, so let's take a look at some of these. I want to start with just Amazon at the top of the list. I think there's a couple lessons here. First of all, Amazon was presented by Hugh McManus at the Roundtable in Chicago on May 16th, 2014. And you guys have all heard the story. I'm not going to belabor it. He presented Amazon, and in a standing room only, there were people actually sitting in the aisles. In a standing room only crowd, not a single person voted for it. We did choose Gentex, by the way, that day, and Gentex has done just fine for Ken. But just a little background on Amazon at the round table, and then this long-term picture of Amazon. And we've got a little story here to tell too, Ken. Well, what are your thoughts?
Well, a lot of times, Mark, we hear about total returns since the initial public offering, and we hear fantastic numbers. And I think the tale you're telling with this graph is that you sometimes have to have a really strong stomach to hold a stock from its initial public offering all the way through to today, especially if it has a 20, 25, 30-year history to it. This is just pointing out that you would have had to live through a 95% decline and a 70% decline in order to say you've held it since inception. And I don't know many of us that would have stood for a big stock with a 95% decline and still keep it in our portfolio. I joked during the green room that probably I would have been out when it hit the 20% decline. I would have been out of the stock. I wouldn't have stood for that kind of decline. Maybe I still thought the company was good, but I don't want to lose that kind of capital. And you would have had to lose almost all of your capital in 2002, just prior, in order to stay invested in Amazon.
Yeah, that Y2K recession was pretty bloody for the tech companies. And Ken, you wouldn't have lasted 20% because back in this time frame, they had no earnings. So
well, then I wouldn't have even been an owner.
But no,
The other thing too, Ken, I mean, besides the sort of negative challenges, look at the RSI on there, and that is the 12-month, the long-term RSI, but
yeah.
always overbought, never underbought. So you also could have waited forever, waiting for what you think is those opportunities, but they were very short, and it never seemed like the right time to buy.
Yeah, yeah. Now, I will say that I do own Amazon today, Mark. I've owned it for probably 3 or 4 years, and I owned it once it developed an earnings history, and once it developed a PE that I could begin to rely on a little bit to see where it was standing in regards to the rest of the market. So I'm not saying I don't own stocks like this. I'm just saying I'm not sure that I could have. Well, I know that if it had no earnings at the beginning, I could not have owned it because I wouldn't own a no earnings stock.
Yeah, I've done it a few times. It's not easy. It's not easy, and it's always a different situation. All right. So again, for a beginner, just be aware that if you do buy into one of those, the example that David Gardner uses quite often is Netflix. You got to be able to withstand some pretty serious declines, and many of us can't. I can't. I wouldn't have made it through that. All right.
Well, maybe that's another caution to make sure that your non-core portfolio is a very small percentage of your assets too, that help that stomach acid.
Yeah, this is an example of a company that at least during the first half of that graph would definitely make it tough to sleep at night. So good stuff. All right. Speaking of sleep at night, here's the 10 cup portfolio over time. Again, a common graph that we show at Manifest all the time. People in this audience have seen it many times, but we have reached back to that $4 million level, and things are percolating pretty well these days. It does include Amazon, by the way, but only the Amazon of the second half of that chart. Um, Here's a look at the portfolio. I did go back and actually look and see what have we sold. We only sold 2 stocks last year. One of them was America's Car Mart, and the other one's going to escape me now that I'm trying to think of it. But anyhow, there are only 2 stocks sold. Everything else was accumulated during the year. Pretty good portfolio from top to bottom. I own several of these, including the Alphabet, Amazon, Gentex, Service First also. Generac, our infamous selection. Of course, Green Brick has been quite popular here lately. InMode is kind of in the doldrums because of the situation in the Mideast. But Ken, you own several of these. I know you
Well,
do.
because I run a taxable portfolio plus 2 IRAs, plus I have sizable holdings in 3 out of 4 of the clubs that I belong to. I own actually, in whether it's in a club portfolio or in my own portfolios, I own 9 of these companies. So I think you're doing either I'm doing a pretty good job of sticking with the winners, or you're doing a pretty good job of sticking with the winners, or maybe we both are. I see a couple on there that I would never have put into my investment portfolio, but for the most part, I like what I see.
Yep. All right.
You know what I'm focusing on, don't you, Mark? Which one? So.
Portillo's is not in this portfolio.
Well, I was focusing on that British one there. So.
Oh yeah, I keep waiting for an opportunity for that one to leave the portfolio, but its current yield is 9.6%, Ken.
Well, okay.
All right. Here's just a quick reminder that program we talked about earlier, we've been doing it for almost 14 years. The roundtable, you can see the selections that were made during the most recent session, and it's a lot of fun. It's just friends coming together to share ideas and walking through those ideas. We do keep track of how well we do at the roundtable. Our objective is to try to beat the market by 5%. You can see that we're hovering pretty close to that level right now. You can think of the rate of return since inception of a being about 16%, and just having a whole lot of fun doing it. And this was born one afternoon, sunny midsummer afternoon, where I mentioned the concept to Ken, and his only response to me was no costumes. It's the only response. And then we launched the program, and there it is. It's actually turned out to be a whole lot of fun, and we have approximately a dozen knights and damsels that contribute to this effort. And I think it's just a phenomenal demonstration of a community at work. Matt's presentation on green brick is getting rave reviews from the most recent roundtable. Cool. Anything else here, Ken?
No, I just am amazed that you can do. I'm not amazed. That's a terrible word to use. I'm very enthusiastic about the fact that we can actually do what we say we should be able to do, and that's beat the market by 5 points. And we've been doing it now since around the 7th year of the roundtable's existence, and that we're almost to year 14 now. So for 7 years we've been at very near or above the +5 return. It makes you feel that all the stuff you've been teaching and all the different people that you've talked to have been able to maybe benefit from something that's going on here. This investing stuff has something to it, I think.
Here's the actual top 20 if you're curious about the current active positions in the portfolio, because we do sell every once in a while. There is one on here that I think will probably get challenged. I see a negative return here for one of our beloved companies, OLED, Universal Display. So we'll probably watch for an analyst update. It will get a whole lot of patience with that type of a growth rate. Just let me say, we are very slow to sell a company with that type of growth rate.
I will say, Mark, that 2 of my clubs own OLED, and that our SSGs are a little bit different with par values than the par that comes up from Y charts here. So it maybe does need another audit. We're not talking about fantastic pars, but we are talking about pars in the maybe 5, 6, 7% area rather than the negative range.
Yeah, and sometimes that can be a result of a bunch of OLED analysts going to lunch together and coming back grumpy. So going back to work grumpy.
The other one, Mark, that's had fantastic movement just in the last maybe week or less is EPAM Systems.
Yes.
EPAM had a par value probably at 10 or 11, probably very average, and that par has been pushed down to 3.3 now as the stock gained. I don't know. I don't own EPAM anymore, so I'm not quite sure what happened, but I'm going to assume it was some kind of an earnings a release or some kind of a major change in personnel. But suddenly, or maybe it's just short selling. Maybe it's covering shorts. I don't know. But it has been really blasted with par, and that's because things have been going real well as far as the price is concerned.
Well, I'll add that to the list to take a closer look at. And
yep,
that was a tremendous example of holding through the Ukrainian situation.
Yes, very definitely.
So,
or buying when the Ukrainian session hit, or adding to.
Did I hear Kim in the background?
Yes, I think you did. I advanced her about 10 minutes ago. So, Kim, welcome. We're glad to have you with us.
Well, thank you so much.
Good afternoon. Anything on the slide jump at you, Kim? Happy New Year.
The one I liked on the previous slide was IBP was on there.
Oh, on this one? Yeah. Installed business products. That's also in the roundtable portfolio. It just hasn't made the top 20.
I feel proud that I was able to contribute at least one.
You've contributed more than one. All right. Greetings and glad to have you with us. All right. This one's just in here because we believe that this slide can be used with anybody who's afraid. This is just simply pointing out that of all the losses in the portfolio, realized and unrealized in the roundtable tracking portfolio, the gains made from the 5-time selection of Microsoft just blow it away. So it's just something to keep in mind, keep in perspective as long-term investors. And I think this slide just, again, every time I see it, I think, what would I ever be afraid of?
Mark, I've gotten a couple of questions about this slide. People say they have copies of the slide with different numbers on it, and this slide has been updated a couple of times. Maybe we'll do our very best to put a date on it. Maybe in the top there we can put as of and then put a date, because I think this particular set of numbers is coming from December 31st now. Am I right?
I'm sure it is before the
Yeah,
most recent roundtable. So
yeah,
I
yeah,
will add a note to my mental file. That's dangerous at this age, but I will try to remember to put in as of a certain date
yeah.
going forward.
And the
All right.
numbers do change, folks, as Microsoft moves up or down in price. You have to understand that. And the number of negative selections changes either.
Yeah,
Sometimes for the goods,
this one got a lot
this
better.
yeah, this number got extremely better in November, December of last year. So,
Or I could just, in the spirit of the St. Louis Post-Dispatch, say that the date is not pictured.
all right.
All right, here's our Twitter provocative slide for the day. This one might actually give a few people a minor migraine. On the left, you have those two friends, Buffett convincing his friend Bill to diversify. This is probably 10 to 15 years ago. At the time, Gates was largely invested in Microsoft. I believe the number at one time was he held 40% of outstanding shares of Microsoft. And then he got married and that all changed.
In more ways than one.
Uh, yeah, there was a real transformation, huh? But anyhow, the numbers are right there in front of you. And then what I find ironic is at the time that he was diversifying, Berkshire Hathaway wasn't. And in fact, they headed in the other direction thanks to Apple. And I continued to think that that's a lot of risk, but we just want to point the condition that it's out there and basically give everybody permission to scratch their head. Any
He likes
thoughts?
the cash flow that comes in with those dividends. He
He
hasn't
does.
found something that's probably going to be able to replace it as well.
Yep. And it's tough. I mean, they've had a heck of a good run in Apple, and a lot of that had to do with his lieutenants convincing him to invest in Apple. But I just find the side-by-side interesting comparison. Any other thoughts, Ken?
Nope.
All right. We did have one other one I do want to throw out there for people out there with portfolios that are a little heavy in Microsoft or Apple or any of those type of companies. We would just encourage you to be very methodical about any trimming and that sort of thing. Watch for opportunities, but you don't have to make that 40% position go away overnight. And I think Berkshire is definitely demonstrating that. All right. So pressing on. All right, Ken, this is our only time for this month. I'm only going to do this
Well,
monthly, but
it's certainly an exciting list of companies compared to what we were looking at every single week last year. So I'm interested that Ardelyx is sitting at the top. I'm very interested that not only is Ardelyx sitting at the top, but Western Alliance is up near the top as well. Both of the two that we thought we might take a real gamble on have proved to be winning stocks. One much more than the other, obviously, but still, you can't sneeze at a 56% total return in a stock like Western Alliance since last October 31st either.
no, this portfolio is in pretty good shape, and there's a lot of accolades being directed at Thomas Lee. In fact, we featured him during a session around or just before Halloween when we were talking about the small companies. But Ken, I think you and I can both take credit for at least for now being temporary geniuses as we promoted the pursuit of these smaller companies in the third and fourth quarter of this year. And these are all returns since Halloween, folks.
With full disclosure, Mark, there is one company on here that I'm shocked to read the press on, and the press continues to be just terrible for for XPEL, and the company is called XPEL, and the ticker is XPEL. I would read very carefully all the negative press that's going on about this company. They are accusing these people of just outright lying to the investing public. about what their numbers were and what their business was and how much business they're doing with various customers and everything else. If any of this ends up being fact, then this company is severely overvalued, and we should just take that into our minds. Right now, the articles just keep a coming, and
Yeah,
whether
good
they're
thing.
writing the articles because of another article they read, or whether they're doing original research, is very difficult to ascertain right now.
So what you're saying is we may be glad that we went back to 20 companies this year.
I think
It's
so. Yeah.
one of them misfires that doesn't hurt
Yeah.
someone. Now I will, in full disclosure, in the last week of the year, did purchase shares of Shockwave. I know Matt has been an advocate of Shockwave. I did add Lantheus. I'm shopping at the bottom of this ranking because they're the ones that have been kind of sluggish. I do have
I
shares
am
in
also an
mode.
owner of Shockwave, Mark. So
I just
not a
find
big owner, but I'm an owner of Shockwave. Yeah.
right, and we
Yep.
covered that. It's a roundtable selection. Go ahead, Matt.
Yep.
No, I just say, yeah, I obviously I've been a holder for a long time. I haven't bought more, but I'm quite confident by the time next Halloween comes in, that'll be changed. There is not in the same vein as Expel, but in the way that the media can grab hold and make associations very easily. Shockwave had sort of issues in its industry, and it's not GLP-1 related. One of the only medical device makers that isn't. But I think all it needs to do is to prove that it can continue to execute, and it'll be fine.
If you remember, Mark, right after we put the list out, Shockwave had a terrible downtrend in its price, and it might have been down as much as 25 or 30% during the contest right now.
Yeah.
So to come back to near zero is a big thing, and I'm as confident as Matt right now that as soon as the people that are writing some of these stories do a little bit more research and sort out the differences between what you can do to clear a vein in your leg, or well, it's usually in your leg or near your heart, but to clear those veins, and that there's two basic kinds, and Shockwave doesn't cause nearly the stress that the other type causes. As soon as they can read those things, I think that Shockwave is going to be a really good stock to own.
And one last disclosure on this slide. Yes, Kevin, I still do own shares of Western Alliance.
Yeah. Laura is saying that the one short seller that put out an article about Technoglass, every time I speak of Technoglass to a group, I'm getting hit with that same article, which is now 4, maybe 5 years old.
Right.
And you have to make the same arguments again. If you can verify anything that's in that article, I'd like to see the verification, because I've been unable to verify any of those facts that are now very old. And meanwhile, Technoglass has done exactly what it promised it was going to do when it set out its business plan. Look at some of the older investor presentations, and you'll be surprised that they're flowing right along with the plans that they made. So it's, you have to watch what the press is putting out, and especially what short sellers are putting out.
Yeah, there's an extensive thread in the Manifest Investing Forum on that company if you want to dig in a little bit deeper as to the specifics of that report. And both Matt and Ken have published stuff on it. Here's our Manifest 40. Again, no major surprises. 40 most widely followed companies by subscribers. Tesla did join the top 40 as of the end of December. So that list is just there for again, there's good companies that are community tested on that list, and wait for them to be on sale. All right, another portfolio that we put together a year and a half ago, and this has proven to be a lot of fun. We basically put together a portfolio of 5 utility stocks. The design of the portfolio is that the dividends from those holdings up at the top of the page would actually pay the utility bill. And so we've got the portfolio up at the top. We've got the ledger. And then the only thing that's really important, that's just like a checkbook, folks. You want that balance to stay above zero. and you can see that the monthly payments are being made, and the utility bills are being paid. So that's one of the looks at it. Here's the look at the portfolio itself. And again, nothing in danger here. This was inspired by Ken Janke's project to get his father reinterested in the stock market nearly 50 years ago. Okay. Next portfolio we put together midsummer last year. We were basically reaching out and thinking about trying to put together a portfolio which could stay intact for 25 years, kind of inspired by Arnold Bernard, the founder of Value Line, and the work that he did back around 1960. And by the way, he put together a list of extremely high quality companies. I believe there were 13 or 14 on the list, and only one, and the only one to fall off of that list since 1960 is J.C. Penney, which seems to be hanging by their fingernails out there in a few places. So we were basically trying to do that, just pick some really good companies, and our objective is to try to beat a target date fund of 2050, and just therefore your edification, and it's a pretty decent shopping list too, under the right conditions. I did accumulate some forward air at the end of the year also. Any thoughts on this one, Ken?
I don't follow this particular portfolio real closely, Mark, but I'm surprised that a portfolio that's this old and that hasn't been basically touched since it was created it has a par that's pretty healthy attached to it. This is a 6-month-old portfolio, and I would expect that we'd have to kind of massage it a little bit, especially after what happened at the end of last year in November and December. But we still have some pretty good par values, some pretty good sales growth going on in this portfolio. Sales growth still 11% plus. That's really good, really good.
Well, we're hoping it stays intact. The only one on there was a speculative non-core purchase of Solar Edge, and that has not worked out very well, but we'll see if gritting our teeth helps there a bit too. All right.
Is Enron still the same though on that one?
Regeneron?
Yeah.
Yeah, that's actually done okay since that particular date, August 15th.
That company's been doing spectacularly, in fact, recently.
Okay. I was thinking one of those biopharmaceuticals had gotten bought out. I can't remember.
Oh no, not Regeneron. Nope.
Okay.
They're continuing to crank along pretty well. This is the other portfolio we put together as we were attempting to capitalize on an electric future. And these are all centered on electric vehicles and that type of stuff. And that one's actually done okay. Some of those solar companies took a hit at the bottom of the page. There's a Chinese company there. But what I find interesting about this one, Ken, is some of the real boring. I mean, the fact that AZZ, that's basically a widget manufacturer. I mean that respectfully and with respect. It's interesting to see the boring company end up at the top there.
Well, and my portfolio appreciates GE being up in the positives for a change. So
we did get some cards and letters over our selection of GE. That company has undergone a dramatic transformation. We had a whole session dedicated to it last summer, and GE Healthcare was spun off, and the sum of the parts is making me really glad that I was stubborn and lazy with the GE that was in one of my portfolios.
Yeah, I've kept GE in my portfolio ever since I have been investing, because my dad left me GE shares, and it's one of the few things that he was able to leave me. And in the last year and a half now, the GE and the stock that goes with it, the GE Healthcare, now have surpassed their basis finally, and it took a good dozen or 15 years for that to happen. It was a pretty high flyer for a while there, but boy, it went into the doldrums for a long time in the 2000 teens.
Yeah, it was one of the sacrosanct companies in the Mutual Club of Detroit, and you couldn't even bring up selling GE with some of the old timers in the room. So There's some emotions involved there too. All right, last portfolio before we go into the project, which we're going to kick off here today, the Bare Naked Million. We don't talk about this one very much. This portfolio was the result of a phone call back on Christmas 2005. A phone call that I received. I was sitting here crunching away, and uh, the caller had just received $1 million and was literally asking me, where would you put it? And my answer to him was basically, well, I would take and put a good chunk of it into the Vanguard Growth. That's an exchange traded fund, the pretty good track record. And then I would go out and try to pick a bunch of industry leaders and just put, and basically let it run. The interesting thing about this portfolio is it's been out there since 2006, and there have only been 7 sell transactions over that 17-year period. And to many people, that's just unfathomable. We've done entire sessions on this portfolio. You can see some of the industry leaders. There are a number of us that have questioned Walgreen. They're actually back in the positive side of questions these days, but you can see how the various positions have done. I am tempted to spin off a little bit of that 3 million because this portfolio, $1 million, has become $7 million, and that's without a fantastic outperformance to the market. But this Vanguard Growth, so I'm going to use this as an inspiration for what I'm going to propose here today. Here's a look at the holdings of the Vanguard Growth
Mark,
ETF.
before you go there, I have a question.
Sure,
Is the Motley Fool one, is that an ETF or is that a mutual fund?
that is an ETF.
Okay,
The Motley,
because I have some real questions on including an ETF like that in a portfolio like this. I understand why it was put there. It was to kind of capture some of the growth from the small cap companies, but I'm wondering if all the work that we do on small caps wouldn't have given us some much better ideas and resulted in a return better than under 2% for the time of the portfolio since 2020. It is $305,000, and
mm-hmm.
that's the only holding that I really kind of question. I don't like to hold things that have lost me money either. And, from 2006, Walgreens Boots has certainly not performed very much. But I especially or I have some real strong wonders about that Motley Fool small cap growth in the portfolio.
Yeah, they've got a better longer term track record. That's obviously been a challenging period of 2 of those 3 years have been really negative. I will confess to a bit of emotional attachment. I know the guy who runs that fund personally, Bill Mann. I've spent some time with him. Again, his longer term track record is pretty good. This is where Hugh McManus would probably chime in with his Irish brogue. Hope is not a strategy, Mark.
Yeah.
So, yeah, I am interested in the concept. They have had a rough run. I'm also kind of troubled that these 2 companies are so similar. So maybe there will be some
Well,
engineering
that
here.
was my other question is there a reason that we're holding Cognizant and Infosys, which are basically the same company, just stationed in different parts of the world? We're getting some questions about holding the Vanguard Growth, but that basically is the money that went there just to kind of put it somewhere to start the portfolio out. Am I right, Mark?
Yeah, I took half and put 500,000 into Vanguard Growth. That's now 3.2 million. And then the rest has been invested over the years in a couple of fun tinkerings, but
Right. And when
industry leaders.
it's growing at a relative return at 2%, 2% is nothing to be sneezed at. So I don't think that was a bad decision at all. You could take some of that money and do a little bit of non-core investing in this, but the whole purpose of this was to kind of have a really a fairly safe portfolio that would give nice capital appreciation. Is that where am I coming from the right direction on the purpose of the portfolio, Mark?
Yeah, because again, Christmas Day 2005, basically suggesting to put a chunk into this, and this is why. Here's a look at the holdings, and as you look at that from top to bottom, it's pretty hard to find one to argue with. Most of those are community favorites, over the years. There's just a couple there that are maybe a little bit questionable, but largely this is an investment that many of us would be comfortable with. In fact,
Well,
many
plus the fact they own the Magnificent Seven. The first seven are the Magnificent Seven. So
exactly. So if you're looking for that sort of thing, notice that the growth rate of the portfolio does check in at 12%. This is okay for an anchor in a portfolio like this. Again, keep in mind there's only been 7 sell transactions in 17 years in that portfolio. So it's a concept that I wanted to talk about a little bit before we go into the next subject, which is Ken and I would like to tinker a little bit, and sometimes we just tinker out in front of you guys, and we want to explore the possibility of doing a real money portfolio as part of these bull sessions. So everybody strap yourselves in for the last 10 or 15 or 20 minutes here. We might go over a little bit. Again, this is just our quick reminder. And this echoes the theme of last week's Getting Started series, including the reference to the Grand Experiment and that book which came out in the 1980s that George Nicholson was largely responsible for. And again, we're just talking about demonstrating this long-term strategic investing. Anything you want to add to that, Ken?
well, I'd like some skin in the game if this is a real money portfolio, and I'm thinking that that's what you're thinking. Am I right?
That's what I'm thinking. It's just
Well,
a
I'd
way
like
to,
some skin in the game. Why don't we go halvesies on this, Mark? Okay.
you want to, well, then we got to form a club, I think. All
Well,
right.
I don't want to form a club, but I would go halvesies with you on this one.
All right. We will hash that out offline, but we
Okay.
can figure that out. And again, just here's a quick reminder of a couple major points that I think applies to this sort of effort. All of the keywords that you hear Ken talk about all the time, the patience, diligence, and discipline, they're right there. And we are interested in just attempting to, as a group, identify high quality companies where there's opportunity and buy them and hold them for as long as it makes sense to do so. So that's what we will be doing with this demonstration. And now here's basically the way these are just notes thrown down on the back of a napkin. So Ken, what do you think?
Well, I like it, Mark, and I think that it would serve almost any investor that we speak to. There are a couple of things that I would ask a novice investor to maybe hold off on for 6 or 12 months until you get really comfortable, especially when we talk about 75% core, 25% non-core. My experience with novice investors is that they love to go for the non-core, read speculative if you want to stocks before they fully understand what it means to invest in good, solid, consistently growing companies.
Well, Ken,
So, I put that off a little bit, but this audience that we have, I think, has plenty of experience that we can put together a portfolio. We can talk about it, and I like the concept.
well, Ken, frisky is always fun until it isn't.
You're absolutely right. And Frisky does take a little bit more understanding of, and maybe a little bit deeper research than people are used to doing. If you want to go Frisky, I think you really have to be willing to dive into the material that's available, and sometimes come to the realization there's not much available to draw conclusions from.
Yep. All right. So those are just the general guidelines. We're going to basically build out the portfolio over the next several months to match those design characteristics. I didn't put it on the slide, but it'll have a growth rate, an overall average growth rate somewhere in that 12% neighborhood. Basically no surprises for anybody that has followed this stuff for any length of time. And if you're new to this, you're going to actually get to watch us figure out what the portfolio needs over the next several months and watch us do it. If you are out there and you're relatively new to this, I just thought I would point out that the Motley Fool does have a a section on what you should probably think about when you're choosing a brokerage firm. And I do have accounts at Robinhood. In fact, that's where I keep what I refer to as my frisky fund or speculative fund. I refer to it as my hood. And when I talk about my hood, my friends know what I'm talking about. That's my non-core play area. I have not ever done anything with SoFi. That's kind of an interesting brokerage firm that's out there that's definitely full service, broad, full service bank for everything. So, and their beginning stuff was really, really pretty elementary. So, I do not have an opinion on having done anything there. And then last but not least, on the top three, at least here, Fidelity, which I would compare and put in the same basket as pretty much Schwab and Vanguard. But
Mark, do you have experience with a Fidelity account, or does anybody in the audience have experience? I'm interested in getting a little bit, another couple sources of proprietary information, and I'm not getting that kind of information from Schwab right now. I'm wondering if there is other information, specifically research, available from Fidelity that's not open to the general public.
I think for what I'd like to do, I did have a Fidelity account. I did transfer it. We now have accounts at E-Trade, Schwab, slash Ameritrade. I just mentioned Robinhood. One of the things that they don't talk about much in this review is the type of researcher access to information that you're talking about, Ken. I think what I'd like to do is put together a more specific table of who has what. Who has S&P CFRA information, and what is out there, who tends to lean on the technical analysis stuff more than the fundamental. I would like to see those questions answered because, as you'll see here, I don't find the research in the article. And there's two things that I would think about in addition to all this other stuff. They're all basically low cost. I mean, some of the firms are going to charge you a little bit, but they're pretty much in a very low cost environment, but very little information here with respect to what research is available. I know that Robinhood does not have much when it comes to research resources. Intrigued by SoFi. I do have accounts at E-Trade. I actually had accounts at JP Morgan. So the Morgan and the Merrill are here. But I would put,
JP Morgan. Mark, JP Morgan used to be E-Trade.
I think you're thinking
E-Trade
of,
got bought out by JP Morgan.
No,
It's still called E-Trade, but I think it's JP Morgan now.
no, you're close. It's Morgan Stanley.
Morgan Stanley, okay.
Yeah.
And then I know that I have Fidelity, but I have not used it. I use E-Trade, Schwab, and I really find a lot of stuff on TD Ameritrade because Schwab has S&P reports.
Yes, and I know that Fidelity also does or did. So,
and I think also E-Trade has Thomas Reuter's reports, and they're excellent for you.
All right, so I think we'll chart those out. I actually went ahead and opened an account for the bull sessions at E-Trade, so you'll see that as we go.
Maybe a strategy for us to use, Mark, if I want skin in the game, is to mirror your investments or our investments, to mirror them in a second brokerage firm, and we can talk about our experiences with the broker as well as other things. Then I'll give you a really good reason. Natalie and I have had to take a required minimum distribution, and it's going to sound like I'm complaining, but I'm not. The minimum distribution, however, is much larger than I anticipated because the portfolios did so much better than I anticipated.
You're buying dinner.
So I can buy you a nice steak dinner, okay?
That mean all four of us, right? Okay.
But everybody, okay? No, that's not good. Yeah, we'll stick to the 4 people in the back room, okay? But
hey, you're handing out the gift certificates in Chicago, so
I do want to put some of that money to work in a slightly different way that I've normally been doing it. And this sounds fascinating, especially if we're talking about 2,000 in and then 100 a month. That's that can be something that can be handled pretty easily. And I don't have an account at Fidelity, so maybe it's time that I open one there. My accounts are all at either Schwab or First Trade out of New York, and First Trade is a very small brokerage that my clubs use, and they're very, very pleased with First Trade, so they won't change from it. I know.
Yeah, and I've heard from a number of people like Pat Donnelly that Interactive Brokers is pretty good. I've never had an account there. So yeah, they're out there, and maybe that's part of the demonstration that I had not thought of yet. So we'll take a closer
Yeah.
look.
I'm getting advice from folks in the audience about watching out for the Medicare premiums and all the other kind of stuff. And that comes, they look backwards 2 years at your income, backwards 2 years. So this distribution, which was taken in 24, they won't look at until 26, but I'm already up near the max anyway. So it can't be that big of an increase in the bill when you're all said and done.
And for those of you new to investing, listening to Ken and some of the people walking around on the streets in New Orleans about how their balances stay ahead of what they spend, I mean, that's just living the dream. All right, so we'll start.
I've had to take RMDs since I was 70 and a half. The people that are just moving into that age range have had it postponed a couple of different times. My sister is still not taking minimum distributions, and she has another 3 years to go yet. But I've been taking them for quite a while. I will tell you that this thing about insurance really can hit you a little bit harder than you expect. On the year when inflation was so big, and that was 2 years ago, and Social Security gave you a nice big bump up. Natalie and I actually made less per month in our Social Security the next year by the time they took out our increased premium for our health insurance. So there's a lot of gives and takes to this idea of your IRAs and the distributions and everything from it. And if we had it to do all over again, I would have wished that we would have put almost all of our money into a Roth IRA and avoided all this issue with taxable income coming into our accounts at our age.
Yeah, and that's probably, again, I'm thinking back to the session we did with Christy Powell. Maybe we ask her to come in and address that topic specifically, because I've been through this, I've at least through the battle with my dad and working to optimize his insurance situation back a few years ago. So it's quite real, and maybe we get Christy back to actually tackle that and talk about Roth conversions again, along with that sort of thing. So we'll put that in the potential hopper. All right, so the account is established at E-Trade. For those of you out there with any of these brokerage firms, it's just as simple as finding their access. You can access it from that Motley Fool page if you'd like, but you can open whatever flavor of account makes sense to you. I'm actually working with a couple of people just beginning investing right now that are going through this process. So some good, clean fun. And so we will basically put our transactions here for all to see. So let's go ahead and close down today with a brief discussion of what I would like to propose. And maybe, Ken, we get into some competing methodologies here a little bit. What I'm showing here is the list of the top performing mutual funds that we commonly publish at Manifest Investing, looking for people who know what they're doing, looking for investment opportunities like Vanguard Growth, because what I would like to do is take the first $1,000 of it and split it into a couple of these, just so that we are instantly pretty much diversified. Very much like was done with the Bare Naked Million. Now you don't have to go that route, but that is what I'm comfortable with thanks to the Bare Naked, and I just basically want to consider. So Vanguard Growth, you can see on that chart. I would like to consider putting $750 into Vanguard Growth and then basically backing that up with that blend of companies we know is effective, 75% medium and large, 25% towards the smaller side. And I just love this fund. It's a traditional mutual fund, but it's out of Jeremy Grantham's operation at GMO. And I just love the companies here. Trust me, if a ticker shows up in this fund that we haven't covered yet or have not looked at closely, we're going to be looking at it. And this is just a pretty good, most of you will recognize those tickers. If you don't recognize the tickers, decent, before we move on, the growth rate is upper single digits, projected returns around 10, so everything's pretty solid. Here's your cheat sheet on tickers and company names. I probably would not want this one in there if I had my choices, but just because the quality's not there.
Yeah, but the one right beneath it may be, Mark.
Oh yeah, I like this one a lot.
Yeah.
And so these guys have done pretty well in a very short track record. So again, from top to bottom, these are companies that we like to study and would like to own for as long as it makes sense to do so. Ken, there's your roundtable selection, top performing roundtable selection for the last year. So these are good companies. So that's my proposal, to basically take add coverage of Jeremy Grantham's fund to the manifest database and take the first $1,000 and invest $750 in Vanguard Growth and $250 into the Grantham's fund, the small cap quality, and that just gets us started. So we'll go shopping for our first individual company selection. We'll be putting basically $200 into the individual companies, and then we'll do that until we get the portfolios built out. So we're basically reaching out to you guys in the audience, say, what do you think we should evaluate? I would love to have, I don't know if we can do polls. I think we have to prepare the polls before we actually start the session. Is that correct, Ken?
We can do polls we're on a GoToMeeting, right, Mark?
Yes.
Yeah, we can do polls. I can do a poll on the fly right during the session. Yeah.
Okay.
You have to give me some time to do it. It's not instantaneous, but I can do it.
Well, we'll prepare for that next month. I guess this is kind of like the point in the wedding where the minister says, or the officiant says, does anybody object?
I know we're doing an idea kind of a thing, Mark. We could create a poll that just was asking you to choose number 1, 2, 3, or 4, and then allow people to just tell us which of those 4 they're going to choose. That could be done beforehand without any names attached to them, as long as you made it clear what number went with what name. Do you understand what I'm saying?
Right.
Okay, we could do a poll like that very easily during a bull session.
Okay, so I guess we will flesh out the procedure or the process on that, but I think this would give us a decent start. Anything else you want to kick around, Ken, before we close up?
No, I think we're in good shape.
All right, so I'll go ahead and make those transactions. If we decide by audience vote to unwind them, we'll certainly just do that. So maybe we'll get a chance to demonstrate that in the not too distant future.
All right.
Here's your reminder that we do archive all of these sessions on YouTube under Manifest Investing. If you looked at the video collection, our 3 getting started are right here. The December roundtable is right here. And all of the bull sessions and roundtables are there for the enjoyment of our audience. And we will be continue to put these bull sessions out there. Just a reminder that our Getting Started series is all right there on the Manifest Forum and on YouTube. Just wanted to point out that this was a page that I put in the Manifest Forum. You can actually reach it at that link. But if you're actually fairly new to this, there was a reading list of 5 or 6 things, and I think after reading those, you might feel fairly good about where this is headed. All right. And as Denzel says, explain it to me like I'm a fifth grader. All right. So with that, I think we'll close down. I just wanted to point out that we do for the entire year 2024, if you use bit.ly/bull sessions, you'll be offered, you can sign up for as many as you want. There are 50 sessions between now and mid-December. And kind of daunting, Ken, when you look at it that way. Some of those may move around based on holidays and various things, but it's there for you to access anytime you need it. You don't have to write to me and ask me, when are you going to put up the next link, Mark? It's out there and it's semi-permanent. All right. So with that, Ken, anything else?
No, I think this has been a good session today, and let's you and I talk in the next couple of days about how we're going to do the mechanics of this portfolio.
Yeah, I think it would be interesting to pool, but boy, if we hit a home run
I'm
and there's
thinking that there's
$1 million,
tax implications, right? I'm thinking there's
yeah.
tax implications. So maybe mirror is better than pooling. Yeah.
Or
So
we could put
yep.
it under your social security number so that you have to handle the taxes, and I'd be okay with
Okay,
that.
I'm gonna close the webinar now.
All right. Anything else? I think we're good. All right. I'll stop the recording. Thanks,
Happy
everybody.
New Year, everybody. Talk to you in a week.